current assessment of the global economy, I think it's challenged. Very obviously, it's challenged. I think that the problems that we're seeing now have been building for many years, maybe even many decades. I think the extent to which they unravel is unknown, frankly. I would love to have the answer. We've kind of, someone said on Twitter the other day that, if you go from 10%, a 5% rate of interest is not a 5% rate of interest. If you're at 5% and you just come from 10%, that's not the same as being at 5% when you're coming from 0%, which is where we're coming from. So we have an entire structure of asset prices, an entire financial system built on cheap funding or zero cost funding. And so what we're now doing is we have non-zero cost funding. And so the whole edifice is now starting to wobble. Now, whether that completely collapses or whether somehow the plates keep spinning for another few years, I said, frankly, I'm not entirely sure. But we set up Calderwood Capital really with this type of market environment in mind. That was the whole idea behind Calderwood Capital. Our whole kind of thesis was that there was nowhere to preserve wealth. There was nowhere to preserve capital in a world of zero yield or negative yield government bonds. Because remember, everything is priced off government bonds. Everything is priced off government bonds. When government bonds were yielding a negative return, and people were talking about how overvalued equities were and how overvalued credit was, etc., and they were, what they were really saying was expected returns are just super low. You were a few years ago, I think that a reasonable expected return from equities would have been a real return of maybe 3%, something like that. Historically, it's been 8%. So things were just, it was really, really impossible for people trying to preserve their capital. And we set up Calderwood with this potential environment in mind. So on one level, although I said we don't have a crystal ball, we don't really know where we go from here exactly. We felt and feel that the risks are skewed in one direction. And as I said, I think that you have to think very, very carefully about how to position your portfolio and how to think about your portfolio in the kind of world that I think that we're now in.
All right, great answer. Fascinating. I didn't know that you founded Calderwood with sort of the thesis that the whole system is sort of based on this house of cards that someday will likely have to collapse when we have non-zero funding out there.
The problem is that everything, I mean, don't forget, I've been sitting in the family office for, maybe, I don't know exactly, I was going to say the best part of a decade, but not quite as much as that. But we've been trying to, family offices are very kind of unique structures, and that typically they're not trying to get rich. They're already rich. They're trying
to preserve capital,
to not be poor.
Right.
And it was very, very difficult. You couldn't find anything really that was going to do that. You were being forced to take crazy risks. And so, when I left the family office to kind of move back to the UK, it was at the forefront of our thinking. To cut a long story short, the easiest thing in the world would have been to short government bonds, right? That would have been on paper. That's the easiest way to bet against this kind of, edifice of credit, which had built up over 40 years. But that's actually not a very good bet, if you think about it. It's, for all sorts of reasons, but it's quite difficult to run because there's still a cost, there's still a carry cost. And what if you're out by 5 or 6 years? The Japanese government bonds have been down at near zero and are still at zero, by the way, for well over a decade. So that wasn't the type of thing we wanted to do. We didn't have, I'm not going to pretend that we saw the future. I'm not going to pretend that we knew when this was going to happen, because we didn't. What we did know was that the risk reward was very skewed. And what we wanted was, is there a way that, suppose the duration bear market kicks in and yields really, really blow up, right? Suppose that happens. We want our capital preservation portfolio to be fine. We wanted to be fine. We wanted to sail through and not really be badly affected by that event. But suppose we're wrong. Suppose interest rates stay at 0 for another 10 years. We still want to be fine, right? We want to, so we wanted to kind of have our cake and eat it. And I said, that is not as easy a problem to solve as you know, you might kind of think. But anyway, we had our own solution to that, and that's really what Calderwood Capital was. That's what it is.
All right. Well, look, so what I'm sensing that you've had to think through is there's sort of 3 phases to this. There's how do I manage capital while the world still continues to sort of defy reality and we continue along in this zero cost world. That's what you've been doing. Then there's the house of cards is starting to fall down. How do I preserve capital through that process? We may be in the early phases of that now here in 2022. You know, things may recover, who knows, but at least this year's been a bit of a year of unraveling. And then at some point there will come a day where maybe the house of cards has collapsed as much as it's going to, and then it's okay, how do we invest for that new world at that time? We're not there yet. But interesting, I'd love to maybe delve into sort of your strategies for each of those 3 phases in this conversation. But before we get to the part of like managing capital, I want to get back to a point you made because it's super, I think, kind of foundational to what we're experiencing right now. You know, you said that the world has been dependent upon zero cost capital. And that's one of the big things that has changed this year. And because of that, people have said, all right, the central banks or most of the central banks are out there hiking, trying to tighten for a whole bunch of reasons, but containing inflation being the biggest immediate one. And a lot of people have said, okay, well, they're going to hike until something breaks because the world is so dependent upon zero cost capital. You raise the cost of capital, something's going to break. We actually, I think, just saw something break in the UK 2 weeks ago, right? When the gilt market, became very unstable and the Bank of England had to abandon its tightening plans and step in and start buying gilts directly. I'd love to get your feedback on this though, but was that a break? And is that break a material part of this journey that we're going into of the house of cards beginning to really topple here?
Yeah, I mean, I think so. I should say that this is probably one of the kind of deepest and most urgent areas of research that they're currently doing at Calderwood. I mean, you mentioned earlier the Popular Delusions report, which I should, by the way, I'm not the author, I'm one of the co-authors of that report. But we do kind of spend a lot of time writing about what we see in the fund, because in the nature of the fund that we run and the money that we manage, we're in some very kind of esoteric areas, to very kind of non-traditional areas, and we get very, very good kind of niche information data points that have very good read across into the kind of broader financial markets. We write about that, and this particular area is one that we're really, really focused on right now because you've talked about you just talked about the UK pension issue as being evidence that something is broken. Actually, there's been a whole bunch of things that are broken this year, and the more niche markets that we follow. I give you an example. Some of the things that we're very active in, that we allocate to, cryptocurrency arbitrage has been kind of important for us. Litigation finance, trade finance, mortgage derivatives, reinsurance, default correlation, other things as well. So we do some kind of funky stuff, and I think we see things kind of from this niche vantage point, maybe a little bit earlier. And so we've seen things breaking, right? So we saw, you probably saw this, some of the cryptocurrency stuff that blew up a few months ago, but that was in one level, that was this crazy thing because it was all cryptocurrency. If you scratch the surface, it was a very, very vanilla example of a banking crisis. That's all it was. You had a bunch of these cryptocurrency firms who were, by the way, were not really cryptocurrency firms in the real technology sense. They were banks, and they were taking deposits, and paying a return on those deposits, which they then invested in assets which they hoped would generate a higher return than the one that they were paying in deposits, which is just, as I said, they were banks. And guess what? Paying out 20% a year was actually quite a high hurdle rate. So when the crypto market turned, he couldn't do it and he went bust. So what you actually saw, I think it was the very first evidence that things were breaking, and probably at the most speculative end of the financial system, cryptocurrencies, and it's blown up. So that was the first thing. The UK mortgages also very, very interesting. Not UK mortgages, UK pensions, also very, very interesting. I don't know how much detail you want to go into, how much your kind of listeners know about the pension system and the pension problem in the UK. Is it worth spending just a moment explaining that?
Please do. Yeah, we've talked on this channel a little bit about it, in that the pension funds basically had to lever up in order to get enough return, because returns were so low in this zero return world. They had to lever up in order to try to meet their actuarial, responsibilities.
Basically. I mean, how did they lever up is where is maybe interesting. I think that on a kind of high level, it's the position that the pension funds found themselves in was really not so different from maybe a farmer, right? A farmer who grows wheat, but doesn't actually collect on his harvest for maybe 9 or 12 months, and during that whole time he's subject to all sorts of price risk. So he might get X dollars a bushel if he's trading today, and that's fine, but he can't actually afford it if it goes down to 0.5x of a bushel this time next year. So he will sell futures and lock in that price. So now if the price of wheat suddenly spikes and goes up, say 5x, and assuming his crop hasn't been damaged, he's long and he's short. So his solvency position hasn't changed, right? The problem is he still doesn't get paid for 12 months, but he's now got a margin call on his short wheat position. So his liquidity position has blown up. So although his NAV hasn't changed, he's become insolvent because he can't meet that margin call.
That's a great example.
That's basically what happens to the pension funds, right? Slightly different. And what they were then doing was saying, well, look, I've hedged. Every time interest rates came down, the value of their liabilities, either future pensions, went up, right? So they were short rates, basically. Sorry, on the liability side. So they were getting hurt by this. So when they actually hedged that position, right, and took a kind of long position, that allowed them to take more leverage elsewhere in the book, because they could say to the regulator, look, we're fine. We're actually, we've de-risked our position. So that's kind of what got them into this mess. And then obviously what happened was as yields suddenly started to kind of rise, and then, okay, their funding position was actually improving. Their liability position was now improving. The NPV had now declined. So their NAV hadn't changed. If anything, it improved for other reasons. But what was now a mess was their liquidity position, because they got this kind of long interest rate position, which has gone massively against them. So the banks are saying, listen, guys, you need to post some margin. And they didn't have any margin. Why? Because they're locked up into private equity deals and into venture deals and all this stuff that they can't sell. So they suddenly start selling just whatever they can sell. At which point, rather than do that, they call the regulator and say, listen, can we fix this, please? I don't think this is a good position we're in, right? So this is what's just recently happened in the UK. But to your point earlier, is something breaking? Was this an example of something breaking? Yes, it was. What do we have? We have another example, another illustration of very, very mismatched liquidity on the assets and liabilities of a balance sheet. And we saw that in crypto. We've just seen it in UK pensions. By the way, we've seen it in the US mortgage market as well, right? If you look at the spread of agencies, again, a little bit esoteric, this is something we follow very closely, something we're involved in, but if you look at the spread of agency bonds to treasuries, we're now at the widest level since Lehman's, right? The widest level since Lehman's. That is distress, right? By the way, 9 months ago, we were at the tightest ever. We were actually on a negative spread, option adjusted. So that shows you how quickly sentiment has spread, right? But you're now getting clear signs of distress in the US mortgage market. Where is the distress? The answer is the mortgage REITs, right? The mortgage REITs who are basically just, leveraging up their agency positions by a factor of 10 and paying it all out as a dividend. Those guys are in a mess. So I think that this UK pension thing, we're seeing it in different places. It's not just in the pension. We're starting to see it all over the place.
Yeah, and again, I think you really put your finger on the center of it, which is the world rebuilt itself around, zero rate capital, and now the central banks are out there aggressively hiking, right? So the tide and the momentum is fast going against all these guys, and that's just going to understandably, start nuking the weaker player first. But the danger is it starts sort of cascading up the chain. It's actually very concerning that you're saying we're seeing basically the same extreme that we saw, last saw during or right before the global financial crisis, especially because it's such a big, such a short period of time before you said we had the tightest conditions, just only 9 months ago, right? And rate of change is a big element in the story, isn't it? Where when things change this big, this fast, it creates sort of like a shockwave through the system, correct?
Yeah, I think that's absolutely true. But I mean, at the risk of getting a little bit technical, one of the things that has been very surprising about this drawdown has been the lack of volatility. Right, the VIX,
in the general market is measured by the VIX. Yeah,
market,
but sorry to interrupt, but I want you to include this in your answer. We're now hearing U.S. Secretary of the Treasury Janet Yellen warning about volatility, increase of volatility in the Treasury auction market. Right?
Yeah, people still listen to Janet Yellen.
That's a great point.
What's the I'm not
right, but the point is she is worried about high volatility in the Treasury market, which is
listen, and that's but again, listen, the volatility in the Treasury market, we've just about hit the peaks that we saw in the MOVE index. At least we've kind of hit the vol levels that we saw during the pandemic, but we're still way under the vol that we saw during the GFC for rates, right? So the volatility that we've seen has been higher in credit markets and treasury markets than other markets unusually. But generally speaking, the statement that volatility has been very subdued this year, that's a true statement. If you're looking at equity vol, or if you're looking at credit vol or rates vol, it's really been surprising how low it's been, how orderly this decline has been. And so the reason for that is because this has not yet been systemic.
Right.
We've had these events in cryptocurrencies. We've seen it in UK pensions. We've seen it in US mortgages. The US mortgage market, not yet the US housing market, but the US mortgage market, the people who own the mortgage bonds, seeing all sorts of funny pricing there because, you're getting distressed sellers. So we're seeing these isolated pockets, but they're not systemic yet. And so you're not getting that big correlation event where everything correlates to one that you saw during the GFC. Because the whole financial system was going under, or that you saw during COVID-19 in 2020, because obviously everyone was affected by COVID in the same way. So far, what we've seen is that it's almost been diversified, because part of this kind of inflationary shock, yes, it kind of damages, it's kind of damaged, say the UK pensions, and I think it's going to be a disaster in other areas like, Canadian housing, Australian housing. These things are just, I think they've got disaster written all over them. But the kind of broader, you've also seen benefits in energy markets. So you're actually seeing people who are providing energy, people who are selling basic resources, they're making new all-time highs. Their credit spreads have stayed very, very narrow because they've been huge beneficiaries of this. So you've kind of seen that you've had this kind of very strange market where, okay, you're hurting some people, but other people are kind of benefiting. And so although you're seeing all this volatility down at the bottom, at the kind of bottom end, at the top end, it feels a bit more subdued than we would have thought. So, I think your question is, does this become a big correlation event?
Well, that's the next question, right? Which is, how contained is this, or is this just little tremors that are working their way up to the big trigger event, and then everything comes down, right?
Well, I think the pieces are in place for a huge correlation event. There's no doubt about that, right? I think that banks are not maybe, as secure as they look, because most of their capital base is in this risk-free asset that's just had its worst year in 5 decades. It's difficult to see how that's okay, right? Why is that? When you've seen such a big drawdown, if you're 10x leverage along with government securities, long-dated government securities, and they're now all trading meaningfully below par, how come your balance sheet's okay, right? It doesn't make a lot of sense. And of course, they'll just say, well, we don't mark that stuff to market because the government securities, they're not going to default. Okay. But that's not the same as saying it's okay. That's just the same. That's what you're saying is that's an accounting trick. And then relatedly, you've still got to fund those assets, right? You've still got a mismatch, right? Where do you fund those assets from? And the answer is deposits. Okay. Well, because I can get, 4% on a money market fund now. Why do I need to put my money on a bank deposit? And the answer is I don't. And so if you start seeing people moving the money out of the banks into the banks, have got to pay 4.5% for their funding. That's not going to fund the kind of treasury portfolios that they've been building up over the last few decades, right? Which are now yielding significantly below. So it seems that that's just one example. There are others, but I think that there's plenty of ways that this can become systemic. I think that the question is, do they actually say, you know what, maybe we should stop this tightening and sound a bit less hawkish on inflation, because otherwise we're going to have another Great Depression on our hands. And as I said, the truth is, you can easily paint the picture. Does that mean it's going to happen? We're not sure. This is one of the things that we're digging into, I say, very, very deeply in our research right now.
All right. So let me ask you to react to this. So Bill Fleckenstein has, a number of people have said this, but Bill was the first guy really to say this loudly on this channel, is he's sort of the opinion still that it's going to be tougher for the central banks to bring inflation down than they would like. And his money is on a systemic break happening before the Fed gets inflation truly tamed, back down to 2-3% or whatever. And he thinks that if indeed that happens, if indeed the Fed pivots before inflation is down in that area, then the bond market is basically going to lose its faith in the Fed of ever being able to contain inflation, and it's going to basically start taking the longer end of the curve up higher than the Fed wants, because it's just said, Fed, you've just showed us you can't contain inflation, and we're going to be living with higher inflation, going forward from here. Do you share that concern?
Do I share that concern? Absolutely, yeah. I mean, I thought you were going to say, do I think he's right? I don't know if he's right or not. I said we try to build a portfolio in such a way that we don't have to make these bets, because frankly, getting these bets right is really hard, right? And you nearly always get them wrong. So, we're kind of not really smart enough to make these predictions. But maybe you can't get the prediction, but you can do a stress test. Right. So what if Bill's view is right? Where's that left our portfolio? Right. And that is where portfolio construction becomes really, really important. But again, I think this is one of the very interesting features of the market right now is how subdued long-term inflation expectations are. If you go to look at 10-year forward inflation rates, they're currently about 2.3%. Right.
Yeah. And they've been coming down too over the past couple of months. Like the market's getting more confident that the Fed's going to succeed.
Well, yeah. I mean, it's, again, without wishing to get too technical, but if you look at the break-even inflation rate, 10-year break-even inflation rate, that's not an expectation of what inflation will be in 10 years. Right. That's the 10-year break-even inflation rate is the average inflation rate over the next 10 years. Right. It's not the same thing as saying what's the expected inflation rate in 10 years' time. But you can back that out of the curve, which is what we do. And if you back out of the curve to say, well, what's the market's implied expectation of the inflation rate, in the year 2031, then what you find is that rate has fallen from about 2.7% to 2.3%.
Exactly.
Over the last few months, which is very, very interesting.
And just so you know, I'm just interrupting to let viewers know, we had Ed Easterling of Crestmont Research on the program last week, going exactly through this chart. So if you're interested in learning about more of this in depth, I'll put up a link to that video here. But keep it going, Dylan.
Great. And listen, I mean, I can put this chart up as well if it's interesting. It sounds like you got it covered. Just let me know. But I think that speaks to a kind of broad-based frankly, it speaks to a broad-based credibility that the Fed still enjoys in financial markets. And I think that the entire edifice, the entire financial edifice is built on that credibility. So it's kind of very reassuring in one way that despite what maybe we think, most market participants are actually reasonably kind of relaxed about the Fed's competence.
Of course, that opens the question: is
what
that
happens
credibility
if that changes?
deserved? Yeah,
Exactly.
or is it deserved? Right?
Yeah. Well, again, there's a who knows. I feel it's not, but I'm wrong. The market seems very, very kind of relaxed about that. So, but I think that kind of that's something that kind of interests us. I think that, as I said, if it changes, I think that you can easily see how this systemic event occurs. And I said, it's one thing to predict it. It's maybe an easier thing to stress test it, right? What do you do to protect yourself in that case? What do you do to protect your portfolio so that you don't blow up in that kind of world? And is there a way to protect your portfolio in such a way that if you're wrong, you still don't blow up, right? You still do.
Right.
You still do. That's kind of more. That's what that's more our kind of approach at Calderwood. It's more about the kind of portfolio construction. So yeah, I definitely have sympathy with Bill's view, and I've been very perplexed by how kind of quiescent long-term inflation expectations have been. But whether or not I'm just biased, whether or not the market knows something I don't, which typically is true. I'd said I don't really know if that's going to happen.
Okay, well, look, so your focus is on portfolio construction and really a resilient portfolio construction, right?
Yeah,
which is,
exactly.
Hey, we don't know with certainty what's going to happen, but we're thinking of a bunch of high probability events, and we're building a portfolio that's going to weather most of them as best as we can, right? And to be honest, that's exactly the bullseye interest of the folks watching here from Wealthion. So I do want to get into that with you. They'll kill me if I don't. But before I do want to stay on the macro side just a little bit longer.
Sure.
So I'm going to ask a micro question under the guise of a larger question, which is, are there other sort of solvency bombs or stability bombs that you are waiting that you think are high likelihood dominoes to fall that you're watching, intently here, given the progression of failures that you're tracking? That's the big question. The micro question is sort of an example of that is the housing market. Now, you mentioned a couple of big housing bubble markets, Canada and Australia. The US housing market is already appearing, I track that relatively closely. That's already appearing to kind of roll over here, and a lot of debate on how low it could go. I tend to take the over on that, meaning I think it's going to be worse than the average analyst is guessing right now. But in the UK, you've had mortgage rates basically go from about 2% not that long ago to like 6% now, and moving higher at this rate. And as I understand mortgages in the UK, and correct me if I'm wrong, people take out a fixed mortgage, like a 25-year fixed mortgage, but it's really only the first couple years of the mortgage that are really at a fixed rate, and then it goes to a variable rate, right? Yeah, that's right. So you have a bunch of mortgages every year that are rolling from the fixed into the variable, right? So you're now having people that are going from paying 2% to paying 6+%, right? Yeah. Let alone new home buyers who are just starting at the higher. Is that going to create sort of the potential for, almost like a 2007, 2008 style correction in the housing market?
Yeah, I think it does. Frankly, I think it's difficult to see how it doesn't. Does it lead? I mean, what does that mean for those economies? I mean, housing crashes are typically quite epic. I don't think you normally get isolated. The housing market crashed, but everyone else is fine. Because
right. And sorry to interrupt too, but I'm assuming it's the same in the UK as it is in the US. Sorry, yes. Where, in other words, stocks. Yeah, we all watch the TV shows, but like stocks are predominantly owned, at least in volume, by like the top 10% of households. So what happens in the stock market doesn't really impact the average American all that much in terms of their net worth every day. But way more households actually own their homes, right? And so a decrease in the housing market creates a much bigger countrywide negative wealth effect than, say, perhaps the stock market correction.
Yeah, or maybe they don't quite own their homes. The bank owns their homes.
Right, but the person psychologically feels the loss a lot more. Yeah,
of course, and they're kind of paying that off. No, Yes, that's absolutely the case. I think that the history of housing crashes is not a pleasant one. You know, we've looked at them, we've experienced them in the UK. I remember as a kid we had a pretty epic bust in the late 80s. You know, we looked at them. We've looked at them at Calderwood. We've looked at the Scandinavian ones. We've looked at the European ones. We've looked at the American one. We've gone back in time, gone back in history. I mean, one of our favourite housing busts or real estate busts was actually 1837 in the United States. You know, kind of fascinating period. But again, you get a very similar dynamic. You know, you get this kind of this edifice of debt, which is built on an assumed asset price, and when the asset price changes and when funding costs rise, it just caves in, and everyone gets hurt. No one really escapes a housing bust. So I think that the situation in Canada is really, really dire. I think it's probably the biggest housing bubble, certainly the biggest housing bubble over the last few decades. I think it's a bigger housing bubble than the US even experienced. Yeah, I think it's going to be ugly. But with all due respect to kind of Canadian listeners, most people in the world don't really care about the Canadian housing market. You know, so from a global perspective, I don't think it's going to be the same as, say, the US bust, right? It's not going to feel that way in Canada, right? But I think from the rest of the world, it's you know, as I said, they don't really care about Canada.
Right. You're talking about from a contagion factor. People are less worried about Canadian housing market.
Event.
Yeah.
Exactly. It's not really a global event. I think what becomes a global event is this: if they all go down at the same time, you know, if UK one goes down, if European one goes down, if US one goes down, I kind of feel, yeah, that's certainly possible, and I do kind of feel that there's an inevitability about it on one level, that the UK one is going to go down. It is going to be painful. Maybe not quite as bad as the Canadian and Australian, New Zealand ones, but it's going to be very, very painful. I suspect that you're going to see something similar in the US, but I doubt very much you're going to get the same financial stresses you got in the US as you got during the GFC, caused by real estate. But yeah, that's something that we're kind of that is one possibility for that kind of correlation event that we've been talking about.
Okay, and on the spectrum between kind of like a global housing market correction, I'm not going to use the word crash, but a substantial global housing market correction, and then what I kind of consider to be the mother of them all, and if you think there's an even bigger one, let me know. But if the U.S. Treasury market were to seize up, that's about the most nuclear of options here in terms of a breakage. Is there anything else along the way between those two that you are kind of looking at right now as a candidate that's got you concerned?
Yeah, well, as I said, you know, I think there's a couple of things, as I said, that, you know, and kind of related to what you said, but just to clarify, I don't think that the problem in real estate markets becomes a banking problem the way it did in 2008.
Because they're better capitalized, per se.
But that's all subject to, you know, marking your government securities portfolio at cost, right? So I think that there is an issue that you could, as I said, this is something that we are really trying to understand at the moment. But how do they? Suppose you've got a portfolio of government bonds, you know, an average maturity of 10 years. What kind of yield is that going to be? And it's probably going to be, I'm guessing, 2.5%.
Mm-hmm.
3%, 2%. I know you've had this for a while, right? Your funding rate for that portfolio has just gone up to 4.5%.
Right.
How are you going to fund it? Right. So even though you're marking it at par, even though they're not trading at par anymore, you're still marking at par because you're allowed to, because that's what the regulations say, because the government securities and there's no default risk. Okay, fine. So you're marking it at par. So there's no obvious kind of balance sheet effect. What actually, how are you actually funding this? I think I was going to say the problem for the banks, a real estate, it's not going to be that a real estate crisis, I think, weakens their capital adequacy, because I don't think as much of this stuff is on the balance sheet. What's really going to be a problem is their government bond security, their government bond portfolio, right? You know, because if you've been building a, you know, typical kind of government bond portfolio over the last 10 years or so, the yield on that is probably going to be, I don't know, 2 or 3%, right? And all of a sudden, the cost of funding that is 4 or 5%, right? So you're funding long-term assets with with funding costs that are way higher than what you're making on the portfolio.
Yeah.
So it's just, I think you can easily see a scenario where you do get this, you actually have a capitalization issues in the banking system. You just lose a bunch of deposits to money market funds. And I said, I think that's, in many ways, that's a different type of crisis to the 2008 one, but the effect is kind of similar. You have a correlation event because all of a sudden everyone's in exactly the same mess.
That's interesting. You're right. So exactly, just like you had a ton of banks at the same time experiencing horrendous losses in their mortgage portfolios. This time you're having them have another commonly shared issue. It's just in a different part of the portfolio.
Yeah, so I think that that's something that we're kind of concerned by. Another thing is that there hasn't been a default cycle yet. You know, we're kind of, the fact is the economy is strong. The economy has been phenomenal. So it's been red hot, and defaults have been very low. So credit spreads have certainly widened, but credit spreads aren't really, you know, they're not massively wide at the moment. They're not massively generous. And I think that's the credit market basically telling you, something bad's going to happen, but we're not quite sure how bad. And, you know, so we're in this kind of no man's land at the moment with credit markets, but we haven't seen a default cycle. How serious is this default cycle going to be? Because, as I said, I think that that's potentially another kind of source of concern that we have.
Okay, so that's banking system risk. So we've talked about credit risk. We've talked about banking system risk. One thing that we haven't really talked too much about is just sort of general market valuation risk. You know, we're in a period right now where people are very concerned about margin compression, profit margin compression for companies. Right, they're in certain cases, revenues are softening while input costs are going up, right? So where I'm going with this is, you know, how big an issue do you feel both, you know, the injury that a market correction could trigger in the system here, right? So that could trigger losses in bank portfolios, whatever. But it could also potentially set off, you know, a wave of layoffs, right? And if we go into a true recession that has a bunch of layoffs associated with it too, consumer spending, you know, gets really whacked, and then you kind of get this vicious cycle where revenues continue to get impaired because consumers are cutting in their spending, and then margins get compressed even further. And you know, you get that sort of nightmare scenario where you're laying off potentially millions of employees. How big of a concern, let me put it this way, how probable do you think a recession is, and how big of a concern do you have about the impacts of that kind of, you know, tossing a market correction bomb into all this?
Yeah, I think that's going to happen. You know, I've never seen a soft landing, frankly. Yeah, I've never actually seen a soft landing in my life, in my entire career.
Soft landing is kind of like a unicorn. We've all heard about it, but we've never actually really seen one.
Every few years we hear about it, and we never see them. I think it's probably a little bit unfair. I think there's certainly been a couple of soft landings. That, having said that, you could say that Canada was a soft landing in 2008. You can say that China was a soft landing in 2008. And Australia too. You know, these kind of countries. 2008 was a vicious crash. People were scared of depression. Some countries kind of got through it just about unscathed. But if you look at why that happened and how that happened, it's kind of difficult to see how that repeats. They had huge fiscal stimulus as a response to the slowdown, and they never quite had the asset bust either. So these were quite unusual soft landings. I can't quite see where the soft landing comes from this time.
Yeah, and just to interject there, you know, China is a really good example where what they basically did to trade for the soft landing is they had very low debt levels. Yeah. And they basically just levered up like crazy. So they don't have the ability to do that again.
Right. But right. I think the difference this time though is that we have kind of opened that kind of MMT box. And I don't think that's going to go back in, you know, so we've been doing like, you know, I understand the political imperative to soften the pain. And so I understand absolutely that if energy bills are going up, causing a cost of living problem, the political impulse is to send those people checks. I understand that, right? It's just that that doesn't make sense economically. Right? You're creating inflation to solve an inflation problem. It doesn't make sense.
You're fighting a fire with more gasoline. Yeah,
that's right. It makes perfect. This is something that I think economists often don't fully recognize. They think that because it doesn't make economic sense, therefore it won't happen. But they don't understand that what makes political sense frequently doesn't make economic sense. But you have to understand what doesn't make political sense, right? It's not economists who are in charge. Maybe some would say, thankfully, it's politicians. So politicians will do what's in their interests, and what's in a politician's interest is to retain power. And the way they retain power is really by kind of buying off constituencies. So if some of their constituencies are hurting and they're in a position to soften that hurt, then they will do what they have to do. So when you look at a place like California, which is sending out stimulus checks to fight the energy crisis, I think that's actually a kind of glimpse of what you're going to see during the next recession. I see Macron today was already having a go at the ECB, even thinking about tightening policy during this energy shock, right? Because Europe wasn't as overheated as America. So you're already seeing politicians leaning on central banks, to the extent that central banks are actually trying to kill this inflation.
Well, so I agree with that. You're saying 1,000%. And this is why what's been happening in the UK is so interesting to me, is because the trigger here for this crisis that we just talked about that erupted the other week was actually a fiscal stimulus, right? It was Liz Truss's, tax cuts.
Yeah.
Right. I agree with you 1,000% that the human actors making the decisions are largely going to make irrational decisions from a pure economic standpoint. They might be very rational from a short-term political standpoint, because they're advancing their own political interests. But we're into this really interesting world now where, you might get the pushback of reality creating unintended consequences a lot faster in this world, right? Like, I don't think Liz Truss had any inkling that when she announced the tax cut there, that it was basically going to just threaten the gilt market, the next day.
So as I said, I think that I think the narrative is wrong. What Liz Truss did as their Chancellor, Kwasi Kwarteng, they announced this unfunded, frankly, not particularly credible series of fiscal policies, and the bond market blew up, right? But I think that the bond market, that's the narrative. So the narrative is the bond vigilantes are back. If governments come out with non-credible policies, the bond market's going to sell off, and that's going to put the politicians back in the boxes. So we're actually going to see market-imposed discipline for the first time in decades. I'm not sure I agree with that narrative, right? I think actually the reason the gilt market blew up was because the gilt market was a time bomb, right? The reason why it blew up was because you had liquidity mismatches on the balance sheets of some of the biggest players. And it would have blown up regardless, because those liquidity mismatches were real, right? So it happens to be the Truss budget, Kwarteng's budget that blew up. If it hadn't been that, it would have been something else. So I actually think that, I actually think that you're going forwards, unfunded, non-credible fiscal policies are probably going to be as achievable and as doable and as easy as they have been over the last few decades. I don't really think the bond vigilantes are back, because ultimately the Bank of England, central banks, as we've seen in the Bank of England, they will backstop it. They will step in and they will buy those bonds to make sure that it's not causing any kind of systemic risk. So I think, again, one of the differences, we talked about the similarities maybe between now and 2008, as we're trying to understand those similarities and understand what the risks of a kind of correlation event are right now. One of the things we think is different is that you will, I think, get the kind of MMT response to a slowdown. You will get an MMT response to higher unemployment. And I think you will probably, related to that, I think that the independence of central banks will really, really be called into question. over the next couple of years when the dust settles on this recession. People will look back and say, what did you guys do? You guys screwed it up. You guys messed up. It was the central bank's fault. And of course, what politicians do, another key kind of logic of power, politicians, they don't, what is the logic of political power? Maintain your own power and grow your own power at all costs, i.e. buy off your constituents if you can. The second thing is blame everyone else for your incompetence.
Yourself. Yeah.
Right. So it's to me, it's the central banks are in the firing line here. When people get right now, they're not angry because unemployment hasn't spiked. When it does spike, they're going to get angry. We're going to blame the central banks. And part of me kind of doesn't have that much sympathy because I'm not a huge fan of central banks anyway. But I do feel quite strongly that central banks are better at running central banks than politicians. So you move into a world where politicians are running central banks more explicitly than they already are. I think you definitely move into this kind of inflationary environment. That's, as I said, so I think that this is a different type of kind of after effect than we saw in 2009-10.
Okay, so instead of it being Putin's price hikes, it may be Powell's recession, at some point in the next 6 months.
But that's also something that bothers me actually, is you're talking about scapegoats.
But that's politics from time immemorial, and you just laid out the game plan there. All right, look, I got to get to basically how you're planning on managing capital through this, because I know that's what folks are super interested in. Real quick, just as short an answer as you can give, because you're over there in Europe right now. I'm just curious, from a European's perspective, like how serious is the situation there as we head into winter, fuel-wise, inflation-wise, and just war concerns wise? This has got to be the worst winter in living memory, I got to imagine, in Europe right now. After the World War II.
How bad is it going to get? It's already bad. Energy bills, they've gone up 4, 5, 6 times. So someone whose kind of monthly energy bill was maybe £100 a month, £150 a month. That's now gone up to £500 or £600 a month. That's huge. That's a very real. That's before their interest is repriced. That's a very real hit. To incomes, and this is kind of very, very standard across Europe. And of course, most people can probably, juggle their finances and just about afford that. But there's a big chunk of people who can't, who are already kind of close to the margins, and actually, so this is a disaster. So again, I don't want you kind of overemphasize it. It's going to be a disaster. I think that the in terms of how bad it gets, we're already going to see. I think, as I said, I feel very. It's difficult to see how we get a soft landing. It's difficult to see how we don't get a recession. I think what's going to come is actually, a huge fiscal stimulus to help support these the consumers and households. But in terms of how bad it's going to be, I think that the storage levels are okay. By the way, I should say I don't have a huge insight here. This isn't really. I kind of read and listen to the same kind of stuff that you guys do. So I don't want to kind of pretend that I have any kind of
but you're living there, and a lot of my viewers aren't. So
so all I would say to them is, listen, it's real, it's happening. Do the numbers yourself. If your energy bill, if your monthly energy bill went up 5x, how would you feel? Because that's what's happening in Europe right now.
And that's just energy, of course, and energy goes into everything. So your food prices must be going up. Right? Yeah.
Oh, absolutely. I mean, I would say that there is a wider conversation about what to do about it. Because prices have gone up, but I don't think there's going to be a shortage of energy, right? In other words, higher prices should probably do the trick to kind of. There's enough in storage. The real problem is going to be next year. We don't have. There's going to be. There's going to have to be political rationing of energy, I think, as things stand. Where are we going to get it from? Unless we all kind of, make up with Putin, then I don't really see where we're going to get it from.
Mm-hmm. And I'm curious on that, is political pressure growing at all to like, hey, let's figure out a way to end this dispute?
No, not at all. I would definitely say no. We've got just as many Ukrainian flags flying around.
Okay, so still pretty committed to current.
Pretty much, and very much. I think it's probably cooled a little bit. But if a politician stands up and talks about defending Ukrainian freedom and the importance to the world of teaching Vladimir Putin a lesson, I think that most people generally agree with that. Now, I think that the rightly or wrongly, but they do. I think that the kind of bigger picture is, the guys the guys who were shutting down nuclear plants and kind of imposing this, well, they were shutting down nuclear plants at the same time as they were building a pipeline to Russia. In other words, they have been in charge of this just absolutely catastrophic energy policy. And they are now still in charge of it, right? So they're the same guys who are mailing checks to cover people's energy bills. And these are the same guys who are in charge of frankly, our foreign policy, our war policy. So this is actually what gives me a bit more kind of cause for concern. I think kind of historically, and again, are you talking about European problems? A really, really good example of incompetent leadership is the First World War. And the First World War was a disaster because our politicians behaved disastrously, completely avoidable. We all shot ourselves in the foot because there was a complete lack of leadership. And I just sense that today we've got very, very incompetent people in charge making these very, very big decisions. I said the political imperative is to blame someone who's not, blame someone for your incompetence without kind of, wishing to defend a guy like Vladimir Putin, who's his own type of scumbag. I think that we've kind of done plenty of things wrong here. And I think that we should be having a hard look at our own policies and trying to learn from them. And we're not. We're absolutely not. It's all Vladimir Putin's fault. So if that's the kind of mindset, it's difficult to see how you solve this very, very difficult problem. So I think that we're kind of, it feels to me that we're moving into very dangerous territory, certainly politically.
Okay, so now let's transition to the real meat here, which is, okay, there are all these macro risks that we talked about. If I can summarize quickly, I think you believe that the markets are going lower. You believe that probabilistically, I think it's more probable that markets are going lower. You think it's more probable that there's going to be a recession, deeper recession that we're heading into, more probable that there's going to be more of these systemic breakages along the way, maybe even sort of a cascade event at some point. So you are constructing a portfolio that is trying to achieve sort of maximum resilience. So how are you going about capital allocation right now? What's your process?
Well, I could say, listen, I for all of this kind of bearishness and talk of risk, you said a moment ago, you think markets are going lower. The truth is that, look, I don't know. I honestly, and that's not some kind of faux humility. I really don't know.
Yeah.
Okay. And to be clear, we don't build a portfolio that relies us to know that, to be able to answer that question.
Right. And I'm sorry, I should have put in my list, one of the options was that everything goes fine.
Yeah. So I think, and one thing I would say is we're definitely seeing some value emerge, right? There's no doubt about that, right? So I said earlier that if you look at the mortgage basis, so if you look at the spread between agency bonds and treasuries, it's at the highest spread, 170 basis points since Lehman's. Now, there's a few kind of funnies, and as I said, without getting into the kind of technicalities, there's a lot of technicalities in that space. But big picture, a spread that was at record heights 9 months ago is now close to record wides. And you're seeing this, as I said, in a few areas, some parts of credit markets, you're seeing value, right? And I'll give you actually the easiest thing. If you're getting a roughly 2% real yield on inflation indexed 5-year bonds right now, right? Guaranteed real return, 2%. Now, I'm not saying that that's empty shout from the rooftops. It's not going to make you rich, but that's actually a hurdle rate. Now for the first time in over a decade, we've got a real hurdle rate, right? You can get I can get 4% nominal, right? 4.5% nominal, and basically close to risk-free bonds, very low risk, certainly, right? Buying at these prices. Buying treasuries at 4.5 is not the same as buying treasuries at a half.
Yep.
Right? So you're paying a different price, you're taking less risk. And I said you can buy inflation protected ones, which are giving you a 2% yield. And of course, inflation comes in higher than that, then your cash return will be actually much higher. So in terms of, is that the best return in the market? Probably not. In terms of the risk-adjusted return, that's a very good place to start. Now, if you see the actual decline this year, there's actually been quite unusual because it's not been very volatile. It's almost like it's been a kind of repricing of of interest rates. Well, if interest rates at those prices are going to start attracting buyers, right? I said for the first time probably in my career, I'm looking at the treasury market and thinking, actually, yeah, should probably have some of these. That has to read across reasonably well for other risk assets. And then when you combine that with actually seeing some quite wide spreads and some very interesting kind of areas in for example, mortgages, by the way, with distress in mortgages, forced selling, non-economic selling, these are actually, and widespread bearishness, this is the kind of foundation, this is the kind of environment you make good returns in, not bad returns. So although I might sound very bearish and very worried, our job is to worry. Our job is to think through these things. If you actually look at the pricing of those risks, I think you're starting to see some interesting things happen. And one of the things we've been doing in the portfolio, one of the things we've been writing in our research to subscribers, is I think you should actually be leaning in. You should be leaning into some of this and looking at maybe some sensible ways to start taking risk. And if you can't think of anywhere to take risk, then 5-year tips is not a bad starting point.
All right, great. So it's great that you're putting that perspective in, which is, hey, look, we don't know what's going to happen here. And so we need to have a humility that even as bad as things may look in certain cases, they may not be as bad as we think they are, or for other reasons, that as value emerges, don't ignore it expecting the world's going to end tomorrow. So you just talked about tips, you talked about treasuries. Where are some of I know you tend to operate in some more esoteric markets than, just buying ETFs and stuff like that. Where are you beginning to sniff out either seeing value right now, or you're expecting, hey, we're going to see value in this space at some point in time, and when we do, that's a space we really want to be in more than we are right now?
Yeah, I think there's a whole spectrum of kind of risks which maybe look interesting, and you've got to remember that sometimes when you're building a portfolio, it's like kind of cooking a meal. You can say, well, I want to take credit risk. I want to take quite extreme credit risk. So something that's quite interesting right now is CLO equity. CLO equity is kind of trading at about 20 cents in the dollar. It's giving you a yield of 10 cents a year, right? So you're kind of getting very, very well compensated for the credit risk. That's telling you there's a lot of defaults priced in.
Okay, and I'm sorry, when you said CLO equity, can you just describe that for people who don't understand the acronym?
Sorry, yeah. So collateralized loan obligations. You have it's called you have a CLO manager. What you do is you take a pool of loans, high yield loans, typically, very often from kind of private equity buyers who are leveraging up the balance sheet of the company that they've just bought. And they kind of they sell those loans into the market. A CLO manager will take a pool of those loans and actually tranche them, right? So that rather than managing a portfolio of 100 loans, he'll tranche them into the first loss piece, the second loss piece, the third loss piece, and then a kind of senior piece, a bit like you would get in kind of real estate. So the equity is the first, say, 10% of losses of that portfolio, right? So if I was to invest, I could invest in senior CLOs. I would get, I'm top of the tower effectively. There's maybe got to be 40% default losses before I start to absorb any losses. So this stuff is super, super low risk, even though you've built it with a bunch of high yield loans, right? Mm-hmm. But the really risky stuff is the equity, right? That's the first loss, right? So as soon as you get if you get any idiosyncratic losses, it's the equity that gets hit first. If you get a systematic loss, it's the equity that gets hit first. So this is very high octane credit risk. But there's a price for it. And right now the price is starting to look, as I said, quite kind of interesting. But as I said, I also said that if you're building a portfolio, it's a bit like it's like cooking a meal. If you had a mouthful of chili, that's probably not going to be a very pleasant experience. But if you just put a sprinkling of it in your dish, it can make the overall dish really sing, really come together. So CLO equity is not something that you want to go out and put your kids' college fund in, right? But if you're going to take credit risk, then you might as well get paid for it. And there's an argument that says, okay, you're getting paid for the CLO equity. That's maybe a smarter way to take credit risk than, buying a high yield ETF, right? For example. So that would, I said, I don't want to get too esoteric, but that stuff is kind of interesting. I think the mortgage stuff that I spoke about, you're getting some very interesting prices in the US mortgage derivatives market. I think you've just seen the biggest ever insurable event likely has just hit Florida, Hurricane Ian. In fact, the first estimate might have come out today. I haven't quite seen it yet. But it's looking like it's going to be somewhere between 45 and 70 billion loss. That's just going to suck a huge amount of capital out of the reinsurance market. The spreads were already quite wide in reinsurance for catastrophe risk. I think this is another area that we are doing an awful lot of research into, because again, there's some kind of issues around it. But so this is a very kind of interesting area. Another area that we like, and this really speaks to our concern that there's a big correlation event. What if we actually, as we dig deeper into bank balance sheets and find that they're holding a bunch of securities and find that they can't, a bunch of government securities that are so underwater they can no longer fund themselves, and basically they're bust. Suppose we get a glimpse of the future, and it's a bit ugly. I think a really good place to hide out is probably quant. Quant is very, very, my partner is at Rentec. So he used to kind of work at Jim Simon's shop. So he knows quant well. We know quant quite well. Quant is typically very, very just fundamentally diversified, very fundamentally uncorrelated to other markets. It's also very liquid, right? So if you're looking for, because if you suppose there is a big correlation event that just sees a puke in all sorts of markets, you want to be able to allocate to, the equity market when it's down 50%. Right? Or you want to be able to allocate to maybe energy companies when they're down 70%, something like that, right? To do that, you need the liquidity. Quant gives you that liquidity. So that's another area that we're really interested in right now.
Okay, and I'm sorry, I'm not sure the average listener is going to necessarily know what you mean when you say quant.
Beg your pardon. So that would be systematic trading. So usually computer-driven trading. Right. Okay. So rather than sit down and go through the financials of Google and figure out the kind of, the balance sheet and the cash flows of Google, and then do the same thing with Microsoft and say, well, it seems to me that we are being paid much more to own Microsoft than Google based on their cash flows. Rather than do that, an algorithm would you have a coder. You would write a computer program that says, here's 30 years worth of data. When is a good time to buy Google versus Microsoft, and when is a good time to buy Microsoft versus Google, and is it a good time right now or not? I don't really care much about the cash flows, right? That's more, and it's typically quite short term. You maybe own it for, but yeah, it's computer driven trading rather than fundamental.
Right. And I just, great explanation. I just want to sort of clarify for folks. So that's something that a lot of institutions do, where they hire their own people as quants to build these models, and then they trade off of them. Is there a way for the general retail investor to get exposure to quant model style trading, or is this just really an insight, telling them how the big guys do it?
I mean, that's it's a tough one. I'm sorry. I mean, a lot of the stuff that CLO equity and reinsurance, I'm not sure how and quant, I'm not sure how accessible this is to a lot of retailers. I was actually giving you an insight into our portfolio, so I apologize.
No, which is great though, because look, the understanding how the big guys play the game is still valuable for folks. So it's all good.
Yeah. Okay. So good. So I mean, I think that there are some UCITS funds that do trend following and these types of, so trend following is another way is one of the kind of vanilla ways that the quants trade. They just look for a trend. If it's going up, I'm going to buy it, and if it's going down, I'm going to sell it. And I stay long as it goes up, and then when the trend changes, then I'll go short. And so I'm very, very agnostic. I don't really care what the fundamentals are. If it's going up, I'm long. If it's going down, so that's why these guys can be very, very good diversifiers, and they're called trend followers. And there are some kind of interesting UCITS. But it's a difficult one, because I think there's a fundamental rule in investing, which is that you should never invest in something you don't understand.
Exactly. Yep.
Right. And so if you don't really know what you're doing in these things, you have to be kind of careful, because it's like anything else. You know, the ones who get hurt the hardest are the ones who understood the risk the least.
Yeah, and that's a very valuable lesson from the School of Hard Knocks that seasoned investors like you have learned. So it's great that you're reiterating that for folks here. Dylan, I hate to do this. We are at the end of our time here. I'd love to keep this going, but I've got another interview that's coming up in just a minute. So real quickly, I was going to ask you about your cockroach portfolio, because we talked about that the last time when you were on here. Folks, I'm just going to say that's a great video to watch after this one. So I'm going to put up a link to it right here. Just the 10-second answer from you, Dylan. Do you feel that the prospects for the cockroach portfolio are still pretty good in this macro environment that we've just talked about?
Simple answer, yes. I mean, the cockroach portfolio is more of a process rather than a timing thing.
Yep.
You know, if you own it for a long period of time, and you don't feel comfortable in your ability to pick winners. In other words, if you don't feel that you know much about finance and financial markets, and you don't want to take bets that you don't understand, and you don't trust someone else to take those bets for you, the cockroach is the ultimate know-nothing portfolio, right? And this year, I think it's down 10%, but it's beaten every single kind of vanilla balanced portfolio.
I was going to say it's pretty good relative to everything else. Yeah.
Yeah, I mean, I said relative, but don't forget this is a portfolio which by design knows nothing. Right, so yeah, I think it's the benchmark we use internally to compare our performance, because obviously we think we know something, so we should be able to do better than the portfolio which knows nothing by design.
Which knows nothing, exactly. All right, great. Well, Dylan, for folks that have really enjoyed this conversation, where can they go to follow you and your work?
So we're, I mean, well, you know, I suppose entry level into Calderwood is, you know, is to subscribe to our own research. We do have a research business where we share some of the insights on some of the kind of esoteric markets that we're involved in. It's called Popular Delusions. Comes out twice a month. I co-write that with the rest of the investment team at Calderwood. We're also on Twitter. We're on LinkedIn. You know, people can hit us up on either of those two places, or you know, reach out to us through the website, calderwoodcapital.com. The usual kind of channels, I guess.
All right. Well, Dylan, look, thanks. This has been a great discussion. I really appreciate you coming back on. I've really enjoyed it. Look forward to having you back on perhaps early next year to give an update when we have a little bit more clarity as to how things are unfolding. Folks, just real quick reminder, Dylan talked about a lot of uncertainties that are out there, both on the negative side and on the positive side. But, you know, as I say on every one of these videos, it's a very confusing, very uncertain time. Most investors, unless you have a lot of investing experience under your belt, will be best served by working in tandem with a financial advisor who understands these macro issues. If you've got a good one, great, stick with them. But if you don't, or you'd like a second opinion of one that does, feel free to talk to for free, have a free consultation with the financial advisors that Wealthion endorses. There's no cost, there's no commitment to work with them. To set up one of those free consultations, just go to Wealthion.com. And if you've enjoyed having Dylan on as much as I have, would like him to come back on in the future, and other guests of his caliber appear on this program, please do us a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Dylan, again, thanks so much for joining us. Everybody else, thanks so much for watching.
Thanks, Adam.